today's class, we are going to be looking at um another topic. Last week we looked at the um what was our topic last week? That's fine. I'm trying to recall. What was our last topic?
Business analysis.
Yes, thank you. Business analysis. Yes, business analysis was what we look at, and we focus on the operational and strategic analysis last week. So we went depth into what operational analysis was about and how we should go about it. What are the things that we should look out for? Those are the things that we looked out for last week. So this week, we're going to be looking at another more or less like a familiar or unfamiliar topic. I'm going to, within the short time, look at um, the difference between over trading. How do we know when a company is over trading or when a company is under trading? We're also going to try as much as time permits us to look at a business valuation. We're going to look at a business valuation. So we will start with the over trading. These are some of the things that we will definitely come about it in the exam. That when you read a case study, they are the things that you should look out for. This company, are they okay? Because all of the both financial and non-financial analysis you are going to carry out is to basically tell us this company, are they doing or they are not doing well?
Yeah.
If they are doing well, what are your recommendations? Or these projects that this company want to embark upon, do you think they have financial capacity to embark upon it? Or what are the other factors that could serve as a limiting factor for them? So we're going to be looking at over and under trading. So let's start. Let's start with over trading. What is over trading? We say that over trading occur when there is under investment in working capital. Over trading, it occurs when there is under investment in working capital. I believe we all know the meaning of working capital. Our working capital is the difference between the current asset and the current liability. That is, talking quantitative now, how to get working capital is different. And this working capital, sometimes we call it earning capital. We call it earning asset or earning capital. Something that you use to earn. And capital, you have your prepayment, you have your inventory, you have your receivables, you have your cash and bank. So these are the things that you trade in. Basically, the resources you use in generating more profit, more cash flow into the business. So we literally call them either earning capital or earning assets or working capital. And we said that over trading occur when there is under investment in working capital. We said that over trading also occur where an organization is trying to do too much. Over trading, it occurs when an organization is trying to do too much or too quickly with little.
Say, that class no olo.
When they are doing too quickly but too little with long-term capital. That is, a company has a long-term capital, let's say
They
debenture or loan capital,
go soon reach
and at the
class.
same time they
Yo, market
they
and
they
now
are not
class.
utilizing the resources
And me
the
guy,
way
yo.
they should utilize it. So is such company is what is
Something is very
over
important
trading.
to them.
Overtrading
Oh
also
God.
occur when there is insufficient control. When there is insufficient control over working capital. That is when the company does not have sufficient control over the working
Turn
capital.
off now. Don't talk again now. See the talk.
Hello, admin. Do we have an admin person on this platform?
Turn off sound.
Turn off sound. Speaker.
Wait.
Hello, hello,
Oh, hello.
Hi.
Mr. Tayo.
Yes.
Hello, can you hear me?
Yeah, I can hear you.
I think we still need to educate people on how to use this, what's it called, this platform. Even if the admin is not even on, is not part of us, I think we should, maybe before the commencement of the lesson, I think we should try and educate everyone that they should try and mute their, what's it called, their mic before the commencement of
See, I
the
didn't
this
been
thing.
admin on the platform. I will have asked admin to give me a co-host right. Where look at the number of time we have to wait for people that continue in conversation, not knowing that the lecture has started and they were unmuted and they were just going on. And you can see even as the lecture is going on, you can see interruption of the lecture. So I will address this after the class. Talk to admin. I actually was trying to do it, but I see that I do not have the right to mute. And I apologize for that. So I will talk to admin after the lecture. So as I was saying, so overtrading now occur where there is insufficient control over the working capital, and this is as a result of insufficient liquid fund to meet the demand of the creditor. When there is insufficient liquid fund to meet the demand of the creditors, overtrading is actually as a result of growth in sales, as a result of a growth in sales at a faster rate, a growth in sales at a faster rate, but that growth is in relation to the level of receivables or inventory at hand. The company is doing too much. They don't have enough. They have insufficient liquid fund to finance the growth in sales. Because you understand that sales is a cycle. When you sell, it's either you receive cash, but we normally say a slogan that a sales is not complete until the cash returns to you. If you sell, especially when you sell on credit, you sell, you have a receivable until you were able to convert your receivable to cash. That is when the sales is complete. Because if you can't convert the receivable to cash, you will not have enough liquidity to procure and more stock, more inventory. And whenever you sell, your money, your sales is in three places. It's either your sales proceed, it's either you have collected it in cash, it's either the sales proceed is in receivable, or that is debtor, those that are owing you, or it's in inventory, that is the portion you have not sold. So it's either you are seeing your inventory like this, or the money is in bank, or the money is in receivable. So, but in a situation where the company do not have insufficient liquid fund to meet the demand of the creditor, then we say that the company is over trading. I want you to take note. The biggest symptom is what? Insufficient liquid fund. Insufficient liquid fund. That is when the company has under investment in working capital. Now, what are the symptoms when you are reading a case study? What are the symptoms you are going to see that make you know that, hey, this company is over trading. What are the symptoms of over trading? Number one, inability to pay salaries. Inability to pay staff salary. It means that the company is over trading. Number two, huge overdraft balance. When a company has huge overdraft is meant to be settled gradually, daily, on a daily basis, so that it will not accumulate. But when you see a company has huge overdraft balance, it means that the company is a symptom of overtrade. Rapid increase in sales, rapid increase in turnover, and at rapid increase in turnover and in fixed assets. The company is procuring fixed assets, but they don't have sufficient capital to convert these fixed assets to cash flow, to utilize it to produce sales for them. Another symptoms is inability to pay tax. Maybe you cannot pay your payee, the staff payee, this withholding tax deduction. You cannot remit it. It's meant to be remitted within 30 days of deduction. You cannot do it. It's a symptom of overtrading. Inability to take advantage of discount, trade discount, is what is a symptom of overtrading. Increasingly reliance on short-term finances. When a company continuously rely on short-term finances like overdraft, short loan, and all of that, it means the company is overtrading. Don't forget, overtrading is insufficient control over the working capital. When you lose control over your working capital as a result of insufficient liquid fund, you can't control your working capital. Now, who can tell me what is the ratio that measures working capital? There are two ratios. Who can tell us?
Current ratio
Hello?
and
Liquidity ratio.
Yes, liquidity ratio, which are,
current ratio and asset test ratio.
thank you very much, current ratio and asset test ratio. And what is the industry standard? What is the standard that we should have, especially for current ratio?
Ratio 2 to 1 for current ratio.
Thank you very
Two is
much.
to one.
2:1.
2 to
Uh,
1. Thank you very much. Thank you very much.
1
It's
to
2
1.
to 1. While quick ratio is what? 1 to
1 to 1.
1 is to
Thank
1.
you. 1 to 1. That is the minimum. That is the minimum. Current ratio should be 2 to 1. That is, when your current asset is 200 million, your current liability should be what? 100 million. It should be ratio 2 to 1. That is, you can actually pay off your current liability twice. Like, you can pay it off like 2 times. That should be the worth of your current assets. And we said, if this should be not be this, if this is not the case, that shows that the company is over trading. Reduction in asset turnover ratio is an indicator. Reduction in asset turnover ratio, as well as the current and quick ratio, is an indicator of what? Over trading. Now, what are the causes of over trading? What are the things that cause company to overtrade? Number one is over expansion. Over expansion. You are opening branches. Let's open branches in Lagos, one in Port Harcourt, one in Calabar, one in Akwa Ibom. You are just open. You are not thinking of, would we be able to control these branches? Would system in place to control the cash flow from that source? Over expansion is one of the causes of overtrading. Inflation. Inflation can cause overtrading. How does inflation cause overtrading? It's because inflation can mess up your cash. That the cash you now have is not enough. Imagine that you have cash, but some of your debtors are in dollars. Some of your creditors, you are owing them in dollars. So you need much more cash to convert to dollar in order to pay your creditor. In order for them to make the supply so that you can have raw material to produce, to make sales. Another causes of overtrading is loan repayment, high loan repayment. We say over reliance on short finances. When you are accumulating your bank overdraft, is meant to be paid off daily. You are meant to reduce your bank overdraft daily. But if you fail, let's say daily charge is 20%. The moment you default, the rate can turn, the rate can change from 20% to 45%. It can change to 35% once you default, because the charges is programmed automatically, and it will charge it on outstanding unsettled balance on a daily basis, and the charges will be dropping on your account. It will be increasing the overdraft. So another symptom is loan repayment. When you have high loan repayment, they are causes of overtrading. It will increase it, will make you, even if any inflow comes into the account, it is the overdraft that will swallow the money. Another causes of overtrading is too much credit sales. Too much credit sale. You sell too much. These are the symptoms you look for when you are reading, so that at a glance you can tell whether the company is doing well or not, whether they are overtrading or not. And that is the decision the company, the examiner want to know. They want you to know that with the symptom you have seen, when you have computed your ratio, what does it tell you? What can you deduce? What can you tell us that this company is overtrading or this company is undertrading? Another symptom is insufficiency of share capital. When you have insufficient share capital, you are trading with so little. You are trading under investments in working capital. Is what is over trading. You have insufficient investment in share capital. That will lead to over trading. What is the solution? Solution to over trading. Number one, you need to issue more shares. Issue new shares. If you see now, because the CBN has increased the capitalization of the commercial bank, the money deposit bank. You see a lot of banks, they are selling share now. They are doing IPO, public offer. Zenith is selling share, GTB is selling, FCMB is selling shares. They are trying to increase their capitalization. Solution to overtrading: number one, issue of new shares. Number two, drop over ambition project. You need to drop over ambitious project. You are planning that, okay, we want to build national stadium. We want to build this. We want to construct this. You say you need to drop over ambitious projects that are consuming money. And in management, we call it mismatch. Financial mismatch. When you use your current capital to finance long-term projects, we call it financial mismatch. Another solution of overtrading is control of credit sales. You have to limit control of credit, to put a benchmark that no, we are not selling on credit. Anybody that has not you cannot buy credit more than this limit. Let's say before, maybe there is no limit, you just sell anyhow. You can say no, maximum limit anybody can buy is 500,000 or 1 million. You just put it like that, a cap on it. Control of credit phase is another solution of overtrading. Another solution is to review your credit policy. Review your credit policy. Review your credit policy, both to staff. Some companies, just see, they are just borrowing people money. They are just borrowing people staff. They are just borrowing them. The staff will collect the money and run away. They will just resign. Some of them will not even resign. They will say, I sack myself. They will go away with the money that, what do you want to do to me? Come and carry me now. Review credit policy. Another symptom, another solution to overtrading is solicit for long-term loan. Solicit for long-term loan. Long-term loan at a reduced rate that can give you some breathing space to do business and make that money back instead of doing overdraft, instead of that is at higher interest and the time of repayment is short. Say go for long-term loans. There are some long-term loan that is in one digit. Maybe the rate is 5% or the rate is 9% or 10%, but you can pay over 40 years or over 50 years. You can now look into that. Anybody that can do that for you at a lower rate. These are the solutions to trading. Now let us look at under trading. Under trading is what we call overcapitalization. Overcapitalization. What is overcapitalization? Overcapitalization is a situation where a company is having too much capital, more than necessary. Overcapitalization is where a company is having too much capital far above the level of operation. They are having too much capital far above the level of operation. That is overcapitalized is having excessive working capital. Excessive working capital. We said the standard ratio, current ratio is 2 to 1. When you now see a company having 300 to 1, that is 300:1, that is overcap. Even if they have 200:1 or 100:1, that is too much. The recommended standard should be 2 to 1. It should be twice. But when you see a company, they are having, there is something they are not doing right. These are the symptoms you should look for without doing any computation. Just look at your current ratio, the total of the current ratio, compare it with the current liability, and immediately you know that, oh, there's a problem. This company, they are over trading. This company, they are under trading. This company is overcapitalized. These are the simple, straightforward financial decisions you can quickly spot without doing any calculation. Let's assume there is no time. There is no time again to do much calculation in the thing that you can easily spot on the face of the financial statement and say, oh, this company is this company is this company is this, and all of those things will fetch you mark in the exam without doing any serious calculation. You can just pick it on the face of the financial statement. That is overcapitalization, which is called under trading. Under trading means you have cash, but you are not trading with the cash. It's just sitting in your working capital. You have excess money in your working capital. That is what? Overcapitalization, or what you call under trading. What are the symptoms of overcapitalization? What are the symptoms of overcapitalization? Huge and unused cash and bank balance. Huge unused cash and bank balance. These are the symptoms. Number 2 symptom is when you have passive expansion program. Passive, not active, passive. That is a expansion. You have so much money that you can use to invest. You're investing the money. The money is just sitting in your current account. You did not put it in fixed deposit. You did not put it in treasury bill. The money is just, bank is just using your money to make more money. That is called overcapitalization. These are some of the things. When you look at your financial, you can easily spot it and recommend. Because what is needed most in the exam is your recommendation, ability to spot problem, ability to articulately identify a problem from the face of the financial statement, and you recommend to the examiner, hey, this company is having problem. You join a new company, you just pick up a job, you look at their financial, you say, hey, there's a problem in our company. The management will say, wow, this man is spot on. These are something that can make you stand out. Ability to spot a gap. Ability to say, there's a problem. Why is it like this? What is it that we are not doing right? It can make you stand out in the office where you work. Ability to spot. What is another symptom of capitalization? Poor share data. Poor share data. Another one is what? poor return on capital employed, poor return, or what we say, poor financial performance ratio, poor financial performance ratio. These are symptoms of overcapitalization. These are symptoms of overcapitalization. What are the things that cause, what are the problem of overcapitalization? What are the problem of overcapitalization? Number one, managers become careless and wasteful with the resources of the company. Managers become careless and wasteful. That's number one. Number two is unreasonable increase in benefit and benefit and perks of the manager. Do you know the problem of Nigeria? When you see, they say unreasonable increase in the benefit. When you say, oh, let us increase the salary of the senators, including those that did not come for meeting and those that come. You will be hearing furniture allowance 500 million. You will be hearing wardrobe allowance 1 billion. You will be wondering that in a poor country, these are the things that pay to a senator. That is what you are saying. Unreasonable increase in the benefit and the perks of the manager. Well, another symptom, another problem of overcapitalization is managers decide to build empire for themselves using the excess capital of the company. Yes, you have had in the same nation where one minister bought bulletproof car, two bulletproof car, one female minister bought bulletproof because there is excess money. They are not doing anything with it. They are just buying cars for themselves. These are symptom problem of overcapitalization. What are the causes of overcapitalization? What are the causes of overcapitalization? Slow pace of expansion. There is slow pace of expansion. Another problem, another causes of overcapitalization is strict credit policy. Strict credit policy, which result into almost all sales on cash. When you have a strict credit policy that you always sell everything on cash, no receivable, all the goods in inventory, they have sold it in cash. Some of the cash have been collected without proper reporting it to the company. These are causes of overcapitalization. Excessive long-term loan, having too much shares in issue, you are just issuing share out. People are just paying because when you issue share, there are funds. It's a form of capital injection into the business. So, but when you now having too much shares in issue, that is why you see SEC and NSE, Nigeria Stock Exchange, and SEC, Security and Exchange Commission, they regulate the banks. As you are doing this, but you must not exceed what you are supposed to issue. There is a specific amount. You cannot just collect money from public and you are not doing anything. What are you doing with the money? They regulate it. They make sure that this thing is being checked. These are causes of overcapitalization. What are the solutions? Solution to overcapitalization. What is the solution? Number one, engaging in a expansion project. Engaging in a well-researched expansion project. These are the solutions. Remember, in the exam, it's your ability to draw conclusion and make recommendation. There, after your recommendation, there are problems they have put in the exam. They are looking for student candidates that will identify the problem and make a good recommendation of a solution to the problem. That is all essence of case study. They want you to identify a problem and provide solution to it in a written form. That is all about case study. Do you even have the technical requirement to spot a problem? These are some of the things that we need when you are reading a case study without doing any calculation. You have already gotten all the answer by the reason of things that you know about overcapitalization and undercapitalization.
Hello, sir. Hello, I can't hear him again. Oh.
Maybe it's network or something. But it's no longer on the platform.
Hello, are you there? Hello, can you hear
Yes,
me?
sir.
Yes, yes,
I can
yes.
Yeah,
hear
it
you
was
now.
network. The network threw me out, but I'm back now. So, what we are looking at the solution of overcapitalization. We said number one, engaging in a well-researched expansion project. Number two, buyback of the company shares. Buyback. When you say, oh, Mr. Lagbaja has 10 million unit of share, buy some of the share back. What have you done? You have injected cash out. You have been able to moderate your share capital. Number three, redemption of shares and debenture. Redemption of shares and debenture. What do you do when you redeem debenture? Debenture is a loan capital. Redemption means you pay back the loan. That is solution to overcapitalization. Another solution is hire visionaries and goal-oriented manager. Hire visionaries, managers that are goal-oriented and they have visions to take the company from XYZ to A or from A to XYZ. They can take the company from the lowest to the highest. These are solutions. You can still come up with more, but these are just few one of the solution you can recommend to solve overcapitalization. I'm going to move quickly to um, share valuation. Now, for share valuation, I want us to know that share valuation is can also be called business valuation. Business valuation. And business valuation is being carried out for unquoted company. For a company that is quoted or that is listed on Nigerian Stock Exchange, it is easy to know their value. And how can we know their value? By their market price per share. Market price per share is what you use to know the valuation of a company that is quoted. But business valuation is being carried out to for unquoted company that is not listed on Nigerian Stock Exchange. We said that business valuation is the process of ascertaining the worth or the value of a business or the worth of a company. Now, let us look at what are the reasons. Of what reason would you want to carry out a business valuation? Of why would you want to carry out? Number one reason why a business valuation is carried out is for inclusion in the financial statement of an entity that has insignificant or non-controlling interest shareholding in an unquoted company. If there is an unquoted company and there is a shareholder that has investment there, and the investor say, I want to know the value of my work, then you need to carry out a business valuation or a share valuation. When you have investment in an unquoted company or a privately owned company, and you need to know the value of your investment, it means that business valuation or share valuation will be carried out to know. It's just like, you remember when you remember what we did in partnership, the solution of partnership, absorption of a new partner or retirement of a new partner. A valuation of the business has to be carried out to know the worth of the partner that is going, or the worth that the new partner need to bring in if it is admission of a new partner. Another reason you carry out business valuation for determining the value of a non-controlling interest shareholder. Determining a value for a non-controlling shareholder in an unquoted company when they want to sell their share. When an unquoted a non-controlling interest shareholder want to sell their share in an unquoted company, then a share valuation or business valuation will be carried. If I want to sell my share and our company is not quoted, it's not listed, and a non-controlling interest now, that is, we have, you know the meaning of non-controlling interest. It's just like we have parent company have 80% and subsidiary have 20%. That 20% what is a minority interest. It's a non-controlling interest. So when the non-controlling interest say, I'm not doing again, then you need to carry out evaluation. Another reason why you carry out business valuation is for determining a value of an unquoted company when they want to merge with another company. That is for merger and acquisition. When an unquoted company wants to merge with another unquoted company, because you cannot see a quoted company say they want to merge with an unquoted company. Not that they cannot match, but the same thing will still happen. They will need to carry out valuation. Instead, that will lead us to what are the method of carrying out valuation of a company, valuation of a company, especially an unquoted company. Some of these things, they are areas that has not been tested in a long time, and it can be tested any because they are in the syllabus. It can be tested anytime on notice. It is good to know it and have an idea so that anytime you see it, at least you will be able to write something tangible in the exam. At least sometimes that you may not be able to read everything, but you remember that, oh, when we receive the lecture, these are the things that the lecturer said. You'll be able to put down something, and that something you put down may be what will make the difference, that diet. It may be what will make the difference. It may be what will be your saving grace to skate through, to pass mark. What are the method of valuing business valuation? Number one, we are going to look at asset-based valuation. Asset-based valuation. Asset-based valuation. When we talk about asset-based valuation, we talk about you determine the value of per share by what the net asset of the unquoted company. You add what? How do you get the net asset? Net asset, that is, look at it, fixed asset plus current asset minus current liability. It will give you the net total asset of the company all over the number of shares of the unquoted company. All over the number of shares. Don't forget that the fact that the company is unquoted does not mean they don't have shares though. The company may not be quoted, but they have shares. They call it authorized share capital. but it's just that it's not quoted, it's not listed on Nigerian Stock Exchange. They have not gone public. That's the only thing. So, but how do you determine? It is the net asset. How do you get net asset? Fixed asset plus your current asset minus current liability. It will give you net total assets of the company all over the number of shares of the unquoted company. Don't forget, business valuation and share valuation is being done for an unquoted company. For a quoted company, you use their market price per share to determine their value. And when we talk about the asset base, you can use the book value, you can use the breakup value, you can use replacement cost value. What do you mean by book value? We all know the book value. The book value is what? Is the cost minus the depreciation. It will give you the book value. The cost minus depreciation will give you book value. Now, that is different from carrying amount. A carrying amount, it is cost of the assets, of the total asset, minus what? Depreciation, minus impairment. Minus impairment. It will give you the carrying amount of an asset. So there is difference between book value and carrying amount. So we said you can use three methods when you are using asset base. You can use book value approach. You can use breakup value. The breakup value is the same thing as liquidation value. Liquidation value. Now, let me go back. When do you use book value to carry out a business valuation? It is upon request. You don't just use book value. You use book value upon request when it's being requested for by the partner. Because the reason is that it's not a true measure of a value of asset because it uses historical data. That is why it's not a true measure. It uses historical data. The book value of the asset that you have bought over 10 years ago, you are using it to determine the value of an asset. You are not likely to get the true picture. Why? Because it uses historical data. Then we go to break up value, which is the same thing as liquidation method or liquidation approach. When a company is about to be liquidated or the solution in accounting, when a business is about to be brought to an end, you use the break up. And under breakup, what do you use? You use the realizable value of the asset. What do we mean by the realizable value? The disposable, as in how much you can realize on the asset. And you know that most time when you talk about the realizable value, it doesn't mean it's the market value, but it is like a disposal value of the assets. When do you use breakup method? It is at point of liquidation when a company is coming to an end. The third one is replacement or current approach. The current approach, you use the market value or current value of those assets. And how do you get it? You carry out a valuation. You call a professional to carry out the valuation of the business based on market reality. And you the value of the asset to carry out a valuation in order to determine the per share of that unquoted company. So another method is what? Income-based valuation. You can use income-based valuation. That is when you use dividend yield. When you use dividend yield or earnings per share. When you use dividend yield or earnings per share, dividend yield or earnings per share or earnings yield to carry out the valuation of the company. So we have asset base, we have income base. And this is how we can value an asset. If you are using dividend yield, the formula is simple. The formula is the total annual dividend. That is the gross annual dividend all over what? The market value of the share. All over the market value of the share. It will give you the dividend yield. Or you use price earnings ratio. That is EPS times what? The PE ratio. To determine what? To determine the share value. To determine the value of the share of the company. But mostly, it is the first approach, asset based, that is common. Mostly in the exam they can give. Not that they cannot test income based, but income based, you already know them in your investor share ratio, in your financial ratio. But they use asset based mostly, so that they will now test whether you should use the book value or the carrying amount, whether you know the difference between the book value or the carrying amount, or the realizable value or the replacement. Reading it, they will have provided those information in the question. But when you see it, that should be a pointer to you that, oh, they could ask for valuation of the business. And this will bring us to an end of today's class. We have looked at undercapitalization, under trading, overcapitalization, and valuation of business. Valuation, business valuation. And we said the business valuation is carried out for an unquoted company. So at this junction, if you have questions, please do ask your question. And by this, we have come to the end of the class. I'll just spend some few minutes to take questions before I join another meeting. I want to say thank you. If you have questions, please, the floor is open for you to ask your question. Thank you. Dara, see me, please mute yourself. Okay, Afis is raising his hand. Please, Afis, unmute yourself and ask your question.
Hello, Mr. Tyron.
Yeah, good evening.
Yeah, good evening. Yes, I would like you to share more light. When you were explaining what's it called, the working capital. So you made mention of what's it called, liquid as part of what should be included as a current asset. So I want to be very sure. Is it have you had a liquid? Because I believe
Is it
liquid should
what?
not be.
I didn't get your question. No, is it what?
Hello, can you hear me now?
Yes, I can hear you
Hello.
now. Yes, I
Yes,
can hear
I
you.
just want to confirm if prepaid. Yes, I want you to confirm, or I want you to share more light if paid expenses included when preparing working capital as part of current asset.
If what?
Paid expenses, prepaid expenses,
Today expenses.
prepaid.
Prepaid. Yes. Prepayment is there. Prepayment is there. Prepayment is still part of your current asset. Yes, it's there.
From hello.
Hello, I can hear you.
Yes, and so I want to understanding. So I think prepaid expense is not something you can convert to cash any longer because it has already been extended. You will only make the payment in advance. So how do you still add that to your current assets when you are prepared, trying to calculate your working capital?
Okay, thank you. If you have current asset for the purpose of exam, like what you said, in reality, practically speaking, when you just like you pay subscription in advance, you cannot get the money back. That one is gone. It's more or less like a sunk cost. You are just keeping it in current asset to write it off over the period. But for the exam purpose, you cannot remove prepayment as part of your current assets. For exam purpose, if you are being given bank receivables, prepayments, you cannot just suddenly remove prepayment that, oh, I will not use prepayment, because prepayment is still part of your current item on current assets. Are we together? For the
Yes,
purpose
noted.
of exam, but
Noted.
practically speaking, you cannot, yes, you cannot, and that is what quick asset is trying to address, looking at what are the items. He knows that some inventory you cannot easily control. That's why I say current inventory, to get to be able to get your liquid assets. Are you getting it? But your point is valid. In practically speaking, prepayment may not, but it's not all prepayment. It depends on the nature of the prepayment. For example, let's use rent. There are some landlord that once you pay them the rent, you cannot get the money back. There are some that if you need your money today, they will give you your money back, because they are not. You understand? It's in different way. There are some rent that when you pay, you can't get it back. It has gone. There are some that even if you are evicting the place today, they are ready to pay you the unexpired amount. So it depends. It's subjective.
Hello, can I come in, please?
Yeah, please come in, please.
So in the area of prepayment, even if you pay in advance and you are no more in need of the rents, and the
Yes,
landlord is not willing to give the money back, you
yes.
can easily get somebody that need the rent and you collect the money and the person will make use of the rent. So it's still a current asset. So
Yes,
even if you
correct.
pay in advance and the landlord is not willing to pay back, you can get somebody that need the rents and
That
you
need
collect
the
the money
rent
from that, and that person
and collect the money.
will
Yes,
occupy the
yes.
place.
Although even that option, some landlords do not accept that. They will say you cannot sublet the place without their permission. That they are the owner of the place. You don't have power to sublet it, despite they
So,
know they
so,
are
so
owning
the
you.
landlord will be willing to give the money. If it's not, if I pay in
I get
advance
you.
and I
The
not
landlord
say that
must be
I
willing
don't
to
need the
give
rent
the
again.
money. Maybe he does
Yeah,
not have the cash at that moment. So he
it,
say, oh, if you get another person,
that's
yes, you
it.
are correct.
So
To
it can
that
still
extent,
be
you are
under
correct.
current assets.
I agree with you 100%. I agree with you.
Thank
I
you.
agree with you. Yeah, I agree with you. And thank you for sharing that. Thank you for sharing that. Okay, so that I don't know if any other person has question. Yomi want to say something.
Yeah, based on the prepayment aspect, I believe the example you cited is on the landlord is based on assumption. So let's look at the posting side also, the posting, the monthly apportionments, and the how this is being accounted for. So shed more light on that.
The posting of what?
The prepayment.
The posting of
Example
prepayment,
of prepayment, you have
the way it's
to
being
want.
posted is that when you have paid for something in advance, you credit bank, you debit your prepayment, and you write it off over the period. We call it amortization. You amortize the cost over, if it is for 12 months. So you amortize it, you write it into expenses. That means you now debit your expenses and credit prepayment
Credit.
on a
Yes.
monthly basis.
Basis.
But you cannot drop it at once because the benefit is more than 1 year. So you can't drop it into 1 month. And if
Yeah,
it is
that's
something that is spanned over 1 year, you cannot drop something that is for 5 years. Yeah. So you have to amortize it over the period of the year it covers, as the case may
Yes.
be.
You're correct.
So I don't know if any other person has question, any other question or clarification.
What
Okay,
after
so in the
Alusa?
absence,
The chapter we treated tonight. What chapter in
Yeah, that is
the video
we
lecture?
treated chapter 6. That should be chapter 7, if I'm not mistaken. Our video lecture. I think last week we treated chapter 6, if I'm not mistaken. I don't know if it be Amungbefuna Wansha. I will check to be confirmed. But I mentioned last week that so it's the next following chapter that we are treating today, which is business valuation, over trading, and under trading.
But sir, this lecture is more elaborate than the video lecture.
I
I,
seriously, it's
I,
an integral part. That is why we encourage people to join this skinny, because there will be things that we discuss here you will not forget on the exam day. Some of them you remember that, oh, when during the lecture, there are something that when I received lecture, I still remember what the lecturer said when he was teaching us. So that's the essence. Is more detailed. And to be sincere with you, I have revised, I have reintroduced new things as diet in, diet out. I go through the past question. I had new things to, so you cannot use. So that's why it's an integral part of the video lecture. Are you getting it? I don't know
yes,
whether you
sir.
get my point.
Yeah,
So
yes,
I
yes.
had new thing, more relevant thing based on current thing that examiners are asking, things that we should know in the exam, direction of questions, past question, and all of that. Those are the things we put together to say these are our course outline that we treat for this diet, just to make sure that by the time you listen to this, definitely you come out successful. And
We are
that's
very
it.
grateful, sir. But
You are welcome.
I
Yes,
want to
sir.
say this thing as advice to Starry Gold Academy. All this
Yes.
lecture you are giving us, I want them to have it as they have that video lecture so that they can
I
give it
I
to the
I
students on.
Thank you, thank you. I noticed that that's why every lecture they are recording it. They
It's
are
okay.
recording it because, to be sincere, some of the things I discuss, if you ask me to come and say it, I can't say everything because I
Yes.
teach the way ahead. So it's not that I've written them somewhere, but I teach as those things comes based on what I have read in the past question, material that ahead. That's the thing.
Thank you, sir. Mr. Taiwo, we pray for
You're
more
welcome.
wisdom.
Amen. Amen. Amen.
Yeah.
Thank you all. Thank you all. Have a very good evening. Bye. See you next week. Bye. Bye,
Bye bye, sir.
everybody. Yeah.
Bye
Have
bye,
a good
sir.
evening. Yeah.
Have a
Bye.
wonderful night,
Bye.
sir.
Take
Thank you,
care.
sir.
Bye.